In order to understand our interest rates, we need to see what other central banks do. Our meeting's next Wednesday, but the ECB this week, what do you expect out of the ECB?
Well, the ECB has to ease, right? We are in a global easing cycle. Everyone's doing a little bit. It seems like they'll move maybe 10 basis points, maybe some more in the language. I don't think that act in particular is the crucial one, but with China easing and the ECB easing and other countries around the world, the Fed about to join the party, I think you'll see more language about easing in the future.
Now, when we see an ease, whether it's this meeting or September for the ECB, when we see soft and easing conditions in China, Australia, Japan, it does affect our rates, especially the long-end rates, does it not, Brian?
There's no question. I mean, we see at Morgan Stanley Investment Management more and more demand for fixed income, which seems crazy given how much interest rates have rallied. But as you point out, our interest rates look meaningfully high. Now, the curve is flat, so that I think limits some of the buying. But then you see it in credit, right? You see it in high yield. There is no question that global interest rates being low impacts demand for U.S. interest rates as well.
Now, right now, 3 months to 10-year, which is the moniker of, giving us a glimpse of the economy down the road. Inversion's a negative thing, whether you believe it's right or wrong. Right now, that spread's about 5 basis points. So if we ease 25 next week, even if the ECB does 10, that could have the effect of taking that inversion out. Could it not, Brian?
It could. There's no question. And I think it'll be really interesting to see the language of the ECB and the language of the Fed. Because I think if the Fed goes 25 and doesn't promise anything else, you could have the opposite effect. You could have risk markets be disappointed. You could have the long end rally. I think the question is this the beginning of the Fed resetting policy, taking out real insurance, hoping to create more inflation or prolong the cycle? And that could certainly steepen the yield curve. And we think it should.
Now, I heard this phrase several times, intellectually defensible with regard to using inflation as the trigger for this quarter-point ease. I personally don't think it's going to make any difference to inflation. I think the Fed is concerned about the yield curve. You finish this off in the last half minute as to what the motivation of the Fed really is on an ease.
Well, a couple things. I think they're using this as a pressure valve release, right? All the things going on in trade wars and tariffs and slowing growth everywhere. I think the Fed sees this as a chance for insurance. So I don't think you can couch it in inflation hasn't hit the target. You can couch it in growth has been too low. But I think the bottom line is, as a risk manager, if the Fed's job is to keep full employment and to keep inflation towards the target, easing rates here makes sense because whether it's steepening the yield curve or giving business confidence, it all will help the broad economy.